The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Sunday best to you. Welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettlear, along with Accunet Mortgage and Accunet Realty Advisors owner Brian Wickert. Our millennial loan consultant David Wickert has the morning off, so it's just Brian and I, the two baby boomers.
Yeah, much to his mother's dismay, David is taking a motorcycle training, licensure course. Today was the last day, so his mother's going to try to find a way to convince him not to ride one of those dangerous vehicles. Have you ever ridden a motorcycle?
Yeah, I've ridden them, but I don't own one. In this day and age of texting and driving, it just makes me nervous to. You can be the safest rider out there.
We have some customers and friends who are orthopedic surgeons, and they call the motorcycle, riding industry an annuity.
Yeah.
It's just,
an endless
stream of broken bones there. Anyway, mortgage lending continues to be great. I would tell you that my sense is, I don't have any numbers to back this up yet. We'll do that next week. But I think the purchase market is slowing down a little bit. I think July is going to be slower. Probably just some disgruntled or discouraged, let's call it, buyers, because the spring season and early summer was so competitive that I think some buyers have run out of enthusiasm. But we'll find out next week. It's just a little too early today on the last day of the month to count the sales in July because we've got to have time for the realtors to put that in the computer system. The good news is, though, that rates came down a tick here at the end of the week. We had the Federal Reserve meet on Wednesday, and their statement was very much as expected, which is, hey, you know what, the economy is warming up. We had that really terrific jobs report last month where we had 274,000 jobs created. But then, and by the way, then the Federal Reserve said, so, we might raise rates as soon as September. Nobody really believes that.
Sure.
They kind of really have their hearts set on doing one more rate increase sometime this year, probably later in the fall. But then on Friday morning, we got the gross domestic product estimate for the second quarter, so that is April, May, and June. And, our $17 trillion economy, and by the way, we've kept talking about $1 trillion while you were on vacation. Mm-hmm. Welcome back, by the way.
Yeah.
And so our $17 trillion economy was expected to grow at an annualized pace of 2.6%. All right, which, by the way, is like adding the state of Michigan again to our overall economy. So 2.6% is about $468 billion worth of increased economic activity. And that was the expectation. Instead, the economy kind of laid an egg, and we only added a South Carolina, which is about $200 billion worth. So in percentage terms, the economy only grew at 1.2%.
Yeah.
Kind of disappointing. I think this is like the slowest pace of recovery in modern history. It's just 1.2%. We really want to be in those 2s or maybe even 3% to really get the economy firing on all cylinders. So because of that disappointing gross domestic product number, and by the way, Europe, which is also a $17-ish trillion economy, if you take the whole Eurozone, they only grew at a 1.2% pace in the second quarter. So you got the two largest things on the planet, the two largest economic things on the planet, the United States of America and the Eurozone, both just kind of turning in tepid economic results. And so that made people buy bonds, sell stocks, buy bonds. And so we ended up the week down a notch on a $200,000 30-year fixed rate with 25% equity and all the other right stuff. Low overhead Accunet was able to once again offer 3.375, which is smoking good. Unbelievable rate. And the APR on that, by the way, is 3.38. and your total closing cost would have been $995. We're going to talk about closing costs later on in the show, because that's kind of something that I think some consumers still don't pay attention to. So that was really good. On the 15-year fix, by the way, end of the week, 2.75 was the interest rate. And we do have a lot of people, by the way, the APR is 2.77, no points. And a lot of people, when they do go to refinance, are interested at these low rates in paying off that loan faster. But, you know what, that 15-year can be a little daunting in terms of, wow, your payment does go up about 35% compared to a 30-year. So we do have the 20-year tweener, and that's at 3.25. So kind of a little bit of a compromise, a slightly better rate than the 30-year fixed, but we're writing some business in that realm as well. Now, there is one thing looming on the economic news horizon that could spoil our low-rate party, and I'm going to tell you what that is when we come back, along with some stories about just how tricky it can be to get approved in today's mortgage world.
And if you have a question, you can reach us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, Michael Rappaport's I'm a Rappaport podcast hit Milwaukee on Friday night with special guest Latrell Sprewell. What did Rappaport learn about the former NBA star who still makes his home in the Milwaukee area? He joins Justin Garcia at 12:07 today on Wisconsin Sports Weekend to talk about that. It is 10:17. We're in the midst of the Accunet Mortgage and Realty Show here on 620 WTMJ with Brian Wickert.
So the spoiler thing that could make rates go back up is the monthly jobs report, and that jobs report for the month of July is going to be released this Friday, August 5th at 7:30 in the morning here, local time. And right now the forecast is that 185,000 new jobs will have been created by the American economy in the month of July. That follows, I guess the actual number was 287,000 jobs were created in June, which is way more than expected. That was just to put it in perspective. In May, we only created 10,000 new jobs, and that's really what made the rates dip. That, along with Brexit, the United Kingdom leaving the European Union, that's what really caused rates to dip back there in early June. So suffice it to say that if this number comes in super hot, like it did last month, where, it's not 185, let's say it's 250 again, that would be bad for interest rates. If it disappoints like it does in May, I think we could see interest rates tick down another notch. By the way, I had the pleasure of golfing with some fellows from White Hirschbeck Dudek on Friday afternoon, took the day off, and I always chuckle because they ask me, so Brian, what's the 30-year fixed rate at? And I always say, well, with 25% equity and all the other right stuff,
yes.
Which involves that whole litany of things because there's so many items that go into pricing a loan today. And I told the answer was 3.375 if you had all the right stuff. But I also pointed out, because I hadn't thought about this in a while, interest rates should be 0.2% lower. They should be at 3.125, which would be unbelievably awesome. And the reason they're not is because back in 2012, Congress and Fannie Mae and Freddie Mac's regulator, the Federal Housing Finance Agency, skimmed off some money. They said, hey, you got to raise the rates that borrowers pay for loans that are guaranteed by Fannie Mae, Freddie Mac, and FHA, which is like 80% of the loans. You got to jack them up by 0.1%. Why? To pay for the payroll tax cut that we all enjoyed for that extra year in 2012. And that's only going to stay in place for 10 years. So let's see. We have until 2022 before that wears off. And then in the fall of that same year, the Federal Housing Finance Agency said, you know what? We need to jack up the rates that people pay on Fannie, Freddie, and FHA another 0.1% just to make them less competitive, because we'd sure like to see the banks do more portfolio lending and not rely so much on Fannie Mae and Freddie Mac. So, folks, the rates are great right now, 3.375, but they could be at 3.125. Kind of shocking. kind of shocking. Okay, so people talk a lot about how it's getting tougher and tougher to get loans approved. Well, it is sometimes, and other times not. So here's my first story of the week about how it is tough if you're right at the edge of approvability. My first story is about a divorced father looking to buy a home from his dad. The dad bought this guy a house when he was going through the divorce, and now the divorce is over, and now it's time for him to buy the house from the dad. No problem there. The issue, Steve, has to do with verifying and documenting this fellow's income and his monthly payments for things like credit cards and spousal maintenance payments. Now, last week on the show, which I'm sure you were too busy to tune into, and I forgive you for that.
Okay.
But David and I did a segment on divorce, in which we detailed or pointed out that when a person has to make a maintenance or child support payment, that's just like a car loan in terms of evaluating the borrower's ability to repay the new loan for the house. And remember, we call this thing debt-to-income ratio, and what the government requires us to do to make sure we're making safe mortgages is measure how much is the person going to spend on their principal, interest, taxes, and insurance on the new house, plus there are any car payments they have, credit card minimum payments, student loans, and in this fellow's case, maintenance and child support. And then so it's a percentage calculation. By the way, we get to use gross income before any income taxes, 401k are deducted. All right, so when we come back, I'm going to tell you the problem that we've got with this borrower, and I'm sure you're going to ask me, well, Brian, you're just not a whiner. How are we going to fix the problem?
Of course.
When we come back. You're
listening to the Accunet Mortgage and Realty Show on 620 WTMJ, and if you have a question, you can reach us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, Waukesha has been in the headlines this year because of its controversial water situation. How has Waukesha Mayor Sean Riley handled his critics and planning for the city's future? Our John McCure covers that and much more during WTMJ's Conversations, which begins coming up here at 11:07 this morning. Right now, though, Brian Wickert is with us. It's the Accunet Mortgage and Realty Hour here on 620 WTMJ. The devil is in the details, as they say, when it comes to verifying income. That's the situation here.
Did you hear my commercial? Did you hear that one this morning sometime? That's my new commercial this week. The devil's in the details.
Well, of course.
Okay. I thought, what a coincidence. No, you're just a careful, listening radio professional.
Yes.
All right, so we're talking about this case where we got a divorced guy buying a house, and let's just say his income's $6,000 a month. All right. So if you're Fannie Mae, their computer system typically only approves a borrower up to a 45% debt-to-income ratio, which would mean this guy could have $2,700 a month in terms of monthly payments for the house and child support, separate maintenance, credit cards, whatever. Well, we knew we weren't going to make that number. So wouldn't you know, for whatever unexplainable reason, Freddie Mac's automated underwriting system will let you go to 49.99. So in other words, in this guy's case with $6,000 a month, we could go to $2,999. We are currently at monthly debt of $3,050. You're $50 too high. Now, one thing we were hoping, by the way, the debt-to-income ratio is 50.38. And if you're like literally 1,000th of a decimal place over, you don't get the approval. So this poor guy's getting hammered at every turn. He does make overtime. He works for a big, huge utility, but the telecom company he works for will not verify overtime. So we're stuck on that. Then you turn the other way and he says, well, you know what? You're counting too much maintenance against me. I'm really not paying that much. Okay, but that's what the court document says. So do you want to spend 2 weeks going back to, get the court documents revised? Not really. All right, this is the part where you ask me, so what are we going to do?
Yeah, so what are our options?
Good job. Well, a couple of them. One is he could pay down, he could make a larger down payment, and I believe he has the money. So he's got to put down like another $5,900. Remember, it was going to be 5% down with no monthly PMI, by the way. The guy's got great credit. So, but that's kind of painful. It's like, do that. Or he's got like $7,000 on a credit card, but that's even more money to make his monthly nut go down. Or kind of another painful solution is we could switch over to FHA. It's another federally insured loan because FHA allows us to go to a 55% debt-to-income ratio. Now, when Becky and I bought our first house, my Aunt Audrey sent us an article because she worked at what was then M&I Bank about, here are the rules for qualifying for buying a house. And the long tried and true number back in the early 80s were a housing income ratio of 28% of your gross monthly income and an overall debt ratio of 36%. Okay? Well, then that quickly liberalized to 33% for your housing and 38% for your overall. And now listen to the numbers that I was just spouting off. 45% for Fannie Mae, 50% for Freddie Mac, and 55% debt-to-income ratio for FHA. I don't think we're really that restrictive when it comes to this issue of debt-to-income ratios. I think that's pretty liberal. So in this particular fellow's case, we are going to be able to get the job done, but we're going to have to make yet another adjustment. Either he's going to have to bring more money down, or we're going to have to switch gears and switch loan programs to FHA. Folks, that's one of the reasons why it's good to work with Accunet Mortgage is we have more than one tool in the toolkit, and there are a lot of banks out there will only sell to Fannie Mae, and a lot of banks don't do FHA. So we've got the complete lineup of loan products to help you when the going gets tough. When we come back after the news, Steve, let's talk about our cool 4 new technology improvements that we've got rolling out here at Accunet Mortgage and making our customers' lives easier and empowering them a little bit more. We're going to talk about that after the news.
Yeah, getting answers quicker. It is now 10:30 on this Sunday morning as we head over to the WTMJ 24-hour newsroom and an update from Colleen Boland.
Thank you, Steve. Breaking news.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert is with us on this Sunday morning. You're listening to the Accunet Mortgage and Realty Show here on 620 WTMJ.
So we're going to talk about the 4, we think they're cool, new technology improvements that we are either have been implemented or are in the process of being implemented at Accunet. And I got to give credit to Quicken Loans, the nation's largest online lender, and their Rocket Mortgage product. Quicken Loans is a registered trademark of Quicken Loans, Inc., and used under licensure from Intuit, by the way, because they're kind of pushing the whole industry, including Accunet, to get more technologically sophisticated. We're going to compare ourselves to them a little later in the show, but for right now, one of the things that we had early on in our company's 17-year history, by the way, we celebrated our 17th birthday this last week, Steve, July 28th every year. And we used to show rates online, but then things got so complicated in terms of all the variables that go into pricing a loan that we had to stop doing it. But now we found a third-party technology that allows us to put most of the variables in. And so now somebody can go to our website. If you click on the Check Rates tab at Accunet.com, we now have 2 choices for people. One says get a human-powered rate quote, or you can get a machine-generated rate quote. So that's the new one, the machine-generated rate quote. And you can put in the key variables, like are you buying, are you refinancing, are you taking cash out. You can put in your credit score, property value, mortgage balance, and the type of property you have, because remember, condos with less than 25% down are priced differently than single-family homes. And then also if you're going to use it as your primary residence or if it's an investment property. So those are the main things that go into getting a rate and fee quote. And then we're able to deliver what I'm calling a PDA, pretty darn accurate, darn accurate rate and fee quote. Not 100% because we don't have the literally hundreds, if not thousands, of technology engineers that the big companies like Quicken have. So we aren't able to make it, 102% precise and guaranteed, but it's a pretty darn accurate estimate. All right. Soon, by the way, you'll be able to sign up and get text messages of like a daily rate, or you can do it weekly on a kind of a standard 30-year fixed and a 15-year fixed with 25% equity and all the right stuff. So if you just kind of want to be in the know of which way our rates are going, that'll be available, I think, by the end of this coming week. Probably all our competitors are going to sign up for that, but that's okay. And then the other cool thing that we rolled out at the beginning of July and has been fantastic is e-sign. Have you ever done a transaction of any kind via e-sign, Steve?
Yeah, where you do an electronic signature.
Mm-hmm.
Mm-hmm.
Yeah. Did you like it?
Yeah, I thought it was very convenient.
Yep. The real estate industry is really ahead of the mortgage industry on this. And I'd say for the last 3-4 years, the majority of contracts that we see now are e-signed by both parties. But it's a little trickier with mortgage lending because we have a less standard set of forms. If you are signing up to buy with 3% down and no monthly PMI, well, that's one set of documents is different than the person who is going to go with an FHA loan or, there's just so many variables. And then Accunet lends in 4 states, not just Wisconsin, but also Illinois, Minnesota, and Florida. And so then there are state-specific forms. So you really got to do a lot of detailed setup work in order for e-sign to function with all the different form sets that we have. But we succeeded in getting that launched, and the customer reaction and adoption has been excellent because it's instant and really, really helps us out, by the way, on purchase transactions where everybody's on the clock. You've got your appraisal and financing contingency deadlines. So rather than sending it out via overnight and then the people get it and sit on it for a couple of days before they send it back, this is really helping speed things up. So that's thing number 3. Thing number 4 is our mobile application. We've had that now for almost a full year, and I forget to talk about it. If you go to Accunet.com on your mobile device, it's the green button right underneath the phone number. It says download our mobile app. If you go to our homepage, there's a link in the upper right-hand corner where you can download our mobile app. And it's really cool because it's like having a loan officer in your pocket. Super helpful for people who are shopping for a home because they can take any home that they're looking at and calculate an accurate monthly payment, not just principal and interest, but also PMI or FHA mortgage insurance if they're putting less than 20% down, and then also taxes, insurance, and if it's a condo, homeowners association. And I realized this, I've said this before on the show, when we were helping our daughter and son-in-law buy a home 2 years ago, she would always ask me, Dad, what's the monthly payment going to be on this house? And I'd say, what do you think I am, a mortgage guy? I don't know. I can't do these calculations in my head. I'm old. So we figured out this mobile app thing. Absolutely really outstanding tool for real estate agents, by the way, too. And then it hooks you right up with our current rates as well. So those are our 4 technology upgrades here that we got going on to make your life easier as a home shopper or home buyer. All right, when we come back, though, let's take, I mentioned Quicken Loans. Let's take a little look at us versus them in terms of both technology that they have available, but then also that thing called closing costs when we come back.
Sure, apples to apples, oranges to oranges. Mm-hmm. You're listening to the Accunet Mortgage and Realty Show on 620 WTMJ.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, if you watch Cooks versus Cons on the Food Network later tonight, you'll see a cop from Wisconsin featuring his famous Captain Crunch stuffed shrimp recipe. Gene Miller's going to get an episode recap from the man himself at 7:51 tomorrow morning on Wisconsin's Morning News. So if you go to Accunet.com, well, I'll tell you what, the changes here, Brian, holy cow.
You like them?
I love it. And if you just, because everybody kind of goes, okay, well, what's the rate? You go to check rates, and then you have, well, Quicken Loans versus Accunet, and that's kind of where we left off the conversation.
Yeah, what do you see there? You're looking at it right now, I bet.
I'm looking at a significant savings is what I'm looking at here.
All right, so here's what I decided to start to do, because I should mention Quicken Loans and Rocket Mortgage are not affiliated with Accunet. Rocket Mortgage is a registered service mark of Quicken Loans, Inc., and Quicken Loans is a registered service mark of Intuit, Inc., used under license. All right, but they're our competitor, and they are a fantastic marketing company and technology company. In order to launch, this was in the mortgage trade publications, they had 500 people working on Rocket Mortgage for 3 years in order to get that put together and rolled out, and they rolled it out with Super Bowl ads, and they've been advertising the daylight out of that product ever since. Well, if you go to Quicken Loans or Rocket Mortgage, you can get a rate quote online, which is what I've started to do, and then publish a comparison. So Quicken Loans on a $200,000 loan with 25% equity and 720 credit on a Wisconsin refinance is offering a rate as of Friday at 3.5 with an annual percentage rate of 3.724. Their total loan cost to get that loan includes $3,500 of discount points, so you have to pay them 1.75 points to get that rate. And then they have apparently another $1,800 of fees. So their total costs, and they don't break them out anymore, but they do have a processing fee last time I applied to them, underwriting fee, plus appraisal, credit report, title, and closing. That all adds up, according to their online rate quoting machine, to $5,301. All right, Steve, you're looking right at the screen.
Wow.
What are Accunet's costs for that same deal?
$685 total.
Wait, did you say 6,000? No, $685.
Yeah.
That's a difference of $4,616. All right, well, I am going to admit right here on live radio that their technology platform is cooler than mine, because you can go onto their Rocket Mortgage system and have them check your credit with no human intervention, and they can verify your bank account balance and history if you're willing to give them your bank account and user ID and password, which you and I have already discussed as boomers we would not be willing to do.
Yeah, there's no way I'm doing that.
But a lot of millennials apparently are. And then they also try to verify your income electronically with no human intervention. I think that's the weakest link in their automated system. I'd be dying to know what percentage of times that actually gets a hit. But if you do all those things, then you can actually also lock in a rate and closing costs online. But you're paying $4,600 for that convenience. And I guess if you're willing to pay that much for that super cool technology, good for you. I'm not. And I don't think most Wisconsinites or Illinoisans or Minnesotans or Florida people are either. But that's the deal. That's the big difference between Accunet Mortgage and Quicken, is their technology and their super-duper convenience is, in my opinion, extremely expensive. Would you agree or disagree?
I'm going to agree.
Yeah. Thank you, Captain Obvious. But they're great marketers, and I think people just go, well, that just must be what you have to pay to get a mortgage, so boom, people do it. And for goodness sakes, save yourself some serious money. And, you know, do I wish we had all that cool stuff? I guess I do. But we find time and time again, you know, people do mortgages once every few years at best. And so as cool as technology can be, we have a really good group of seasoned, caring, smart loan consultants, we call them, who work with people up front to help them decide what to do. Sometimes the choice is not always that obvious. All right, so there you go. That's your comparison between us and them. When we come back, I got one more story from the front lines of mortgage lending that was the impetus for my ad this week called The Devil's in the Details.
You're listening to the Accunet Mortgage and Realty Show on 620 WTMJ.
Helping you find a place to call home. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, it looks as though Jonathan Lucroy may remain a Brewer. He's vetoed that trade to the Cleveland Indians, mainly because he wasn't going to be guaranteed a starting job every single game. But the trade deadline still looms out there. Other teams are interested. It's always coming down to the details in the deal. And that's kind of where we are in the conversation this morning here on the Accunet Mortgage and Realty Show with Brian Wickert.
The devil is in the details. That's very interesting that he has that clause. I guess I wasn't paying close enough attention. When's the deadline, by the way? Is it today?
I think it's 6 o'clock tonight.
Okay, so either something will happen or it won't. Yeah. Of course, all of us want to see him stay. We love Jonathan Wickert.
Sure.
Okay, so when it comes to mortgage lending, we had one story already in the show about the devilish details. This one is also on a purchase transaction where, you know, we you know how much we love our Rock Solid pre-approval program because it flushes out the details before you're on the clock of a purchase contract. And so this particular couple called us up and said, yeah, we want to get Rock Solid pre-approved, and we took their application, got their credit, and then like within a couple days before they got all of their documentation to us, they called and said, well, we have an accepted offer. They kind of got excited and jumped the gun, or maybe it was just the perfect house that came up and they couldn't resist.
Sure.
You know, and I guess that's understandable. But in this particular case, one of the borrowers had switched from a salary position to a commission position. And, of course, in the application interview process that we do human being to human being, we do it over the phone and 9 times out of 10. But we say, so when did you start getting that commission income? 18 months ago. Well, okay, the Fannie Mae Freddie Mac rule is 2 years. But, 18 months, putting 25% down. Yeah, let's give it a try. Well, it turns out then what you have to do when you're verifying commission or overtime is you have to get a verification of employment from the employer, because you can't typically tell just from the pay stubs, or you definitely cannot tell from the W-2 when did the commission start, right? So there's some back and forth. We end up not getting the verification of employment that spells that out until really late in the game. And it turns out it's only been a year, not 18 months. So that's too much of an exception for Fannie Mae and Freddie Mac. Now we're in a scramble because in FHA, which again, it's good to deal with a lender that has more than one tool in their toolkit, FHA's requirement is also 2 years, but they have it printed right in their rule book that we'll consider as little as 1 year if there are substantial compensating factors. Well, the typical down payment on an FHA loan is 3.5%. These people are putting 25% down. So we're thinking that is a very substantial compensating factor.
Sure.
To say, well, maybe we can swing with this, only 1 year of commission history. So we're now in the process of switching gears here, but way late in the game. And, of course, it's a problem, right? Because people are expecting it to close, and now we got to have this delay, and it's just not good. So I just can't emphasize enough. There are some people that are so extremely boring, it's awesome from a mortgage lender standpoint, right? Yep, I'm a salaried employee. I have been at my job for 10 years. Nothing has changed. I'm stable as the Rock of Gibraltar. The money has been in my bank account forever that I'm going to use for the down payment. Awesome. Maybe that's the one guy or gal or couple that doesn't really need a Rock Solid pre-approval. But it seems like a lot of people always have at least one thing that's a little goofy. A gift or whatever. Oh, you know what? I didn't tell you. I'm going to take the money out of my business account for the down payment. It's like, there are all kinds of little things that can be trip-ups. We want to get those things out on the table, documented, and decided ahead of time. That's what the Rock Solid pre-approval is all about, rather than doing it under the time crunch of deadlines that we have in this particular case. All right, so to recap, we have got a dip in mortgage rates here late in the week because our American economy took a little step backwards relative to our gross domestic product number for the second quarter. So did Europe, so that had people worried about our economic growth and believing that the Federal Reserve is not going to raise rates for the rest of the year. So we're back down to a 3.375 rate on the 30-year fixed rate with 25% equity and all the other right stuff, which is awesome. The APR on that is 3.39, because you always have to say the annual percentage rate, Steve. If you say a rate in mortgage lending, you got to say the APR.
Sure.
But the other thing that's coming up this week is the monthly jobs report on Friday. And last month we had a big surprise on the positive side, and if that happens again, that'll be bad for rates. So guess what? If you're sitting there thinking, gosh, maybe I should take a look at refinancing. I would do it tomorrow. No reason to wait until we get closer to that possible spoiler event. And remember, it may only take a 0.5% reduction in your interest rate. If you've got a $200,000 loan, a 0.5% reduction in your rate is $1,000 a year, every year. That's a big deal. And we may not even need an appraisal to get the job done. All right, that's all we have time for on today's show. Steve, welcome back to the show. Good to have you back. We'll see you next week.
You got it. This has been the Accunet Mortgage and Realty Show on 620 WTMJ. It looks as though Jonathan Lucroy has vetoed that trade to Cleveland. We'll get details coming up here from Colleen Boland in the WTMJ 24-hour newsroom next.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.